Hello and welcome back to the Dukascopy TV Centre. As always, we strive to bring you the best interviews on the hottest topics in finance, and today is no different. Joining me today is Max Roth, Chief Investment Officer at BCV, who's here today to discuss with me commodities, a market that has experienced some big changes off the back of Eurozone developments this week. Max, welcome into the studio.
Thank you.
Oil surged on Monday for its biggest gain in 6 weeks after Greece's approval of bailout measures. Between this and tensions worsening in Iran and Israel, do you think we can expect to see a continued uptrend in prices?
Well, I think there is scope for more upside on oil, especially because people are quite pessimistic about future economic growth. We think, by the contrary, economic growth will surprise on the upside. So all the demand coming from a better economic environment will be welcome. So, well, now it's difficult to see how much the potential is, but I think the next resistance would be 10% higher. So this is a reasonable target for the first 6 months of the year.
With oil so politically relevant at the moment, does this impact on the risk that investors are willing to take on it?
Yes. We can see oil like last year, like a put on risky assets. For example, when on the Arab countries revolution striked, we saw stocks going down and oil surging. So in a global portfolio, being exposed in oil markets, if and when, I don't hope so, but if there are some difficulties on geopolitical side, makes sense.
Converse to this, gold experienced a drop following Moody's downgrades. Gold prices edged lower on Tuesday, tracking a weaker euro. But these movements so far seem to have followed investors' expectations. So what can we see in the future for gold prices?
Well, it's still supportive because the real yield are negative. So as long as it is the case, it's difficult to be a bear on gold. But on the other hand, what we can notice is that the real effective exchange rate of the dollar is on a very cheap level. If you look at the BIS REER, the dollar has reached a low comparable to the low of the dollar in 1980. And if you remember, in 1980, that was the previous top for gold. So this has caught my attention. So structurally, dollar is in a very competitive situation. The US has built relative competitiveness for this economy because they have put down the dollar. And of course, that's why the gold went up. But just imagine that if now we are as cheap as in 1980 for the dollar on the valuation side, that makes things, maybe there are one of the biggest push in favor of gold that is disappearing. I'm not saying that the top of gold is done yet, but if on the US housing market we'll see the excess supply disappearing, which is something possible in the end of the year, then the need of accommodative monetary policy in US will not be present anymore. And if it's no more present, it will enable the US negative real yield on US turn positive. And this will be a deadly action for gold and precipitate gold in the bear market and dollar upside. We are not there, but please watch out.
There appears to be two thought processes behind the impact that US quantitative easing could have on gold prices. Some seem to feel that it could weigh on gold, whereas others alternatively think that it could offer support. What's your views on this?
Well, it's clear support because it keeps the real yield negative. So gold is known to be a hedge against inflation. That's not so sure. It's more an asset that works very well when real yield are negative. So quantitative easing is keep rates low and possibly below inflation in order to push people in risky assets and try to support the economy. So that's a big support for gold nowadays.
If we move now on to agricultural markets, they ended mostly higher, adjusting to the dollar's weakness and also some worrisome crop weather. Is it difficult to make predictions on agricultural markets, bearing in mind that they are so susceptible to acts of God factors almost, such as weather, livestock disease, etc.?
Agriculture is really a headache. If you want to predict the crops, it's very difficult. There are people trying to guess what will happen looking at the sun. The sun activity is supposed to give some prediction about the climate. So if there is increase in sun activity, some people say that the crops are going to be bad. I'm not a specialist about sun activity and the link with agriculture, but it's funny how people are looking at things in order to solve the problem. Well, we tackle this in this way. We are more thinking in terms of how the economic growth will be, and are people more in the cyclical mood or in a defensive mood. So you noticed recently that agriculture has done on a relative basis not very nice return, and all the money has flowed to base metals, industrial metals mainly, on oil too, but mainly on the cyclical component of the commodities, and this has been done on the expense of agriculture. The push has been quite substantial for basic metals, so there could be some catch-up for agriculture, some rotation in favor of agriculture. But the main theme during the year, I think, will still be for cyclicals.
Wheat demand in US exportations is rebounding as supplies diminish in Russia and Eastern Europe. Can this unpredictability therefore also provide positive opportunity?
Yeah, I think there is still some big problems in supply and providing the necessary and timely supply regarding the agriculture products. So I think this could be a support. So we should not neglect, even if we are positive on the cyclical side. If you reason agriculture versus cash, then it's also a nice way to get return in this sector.
The commodity outlook seems generally more positive than it has done for some time. Do you think this is because people are looking to invest their money in actual assets, something that is a product?
Mm-hmm. Well, I think people are focused on tangible assets, stuff things like real estate, commodities, infrastructure, land, and this is a very friendly environment when you have negative yields and when the rates are very low, even below inflation. So this is what has driven all these assets for the last decades. And but to talk about now, I think we are going to experience a better economic environment, and monetary policy in general is more friendly. So the first asset of choice would be normally stocks, then second commodities. And commodities will be still positive for commodities, but stocks even more so. And the second aspect, the time for commodity will be when the economic growth will be acknowledged by the community and rates will start to rise, I think, from the second quarter. So the place for commodity as a star of asset class will come later in the year, but it's still good to be invested in.
What impact, if any, do you think Moody's adjustment ratings will have?
Well, I want to be politically correct, but rating agencies are late in the game, as usually. So I look at it as a contrarian news. news coming when everything nearly is done on the financial market. If you notice, all the news on the rating agency recently had not really had a big impact in the market. So it seems that now the rating agencies are more adjusting to what has happened on the market than leading. And this is the normal behavior. For decades that has been the case, and I think it will be the case for the years to come.
Max, thank you very much.
It was a pleasure.
That's all we've got time for here today. However, do stay tuned for all of your latest analysis, updates, interviews, and the latest from the Geneva Forex event. For now though, goodbye.